Do you know Sears Holding once traded at $138 per share and was the number one retailer in US? But now it has closed most of its stores and Sears Holdings share are basically penny stocks right now. And you can only buy them over the counter and not even on stock exchanges like Nasdaq. What happened exactly? There are many reasons, but one of the main reasons for the drop in stock prices was that it could not manage its short-term liquidity ratios. That is, managing its liabilities and payments to its suppliers and debt holders. In this video, we'll learn all about liquidity ratio and how it impacts the company. Here we will discuss three main types of liquidity ratios like the current ratio, quick ratio, and cash ratio. Hi all, my name is Dheeraj Vaidya from wallstreetmojo.com, the home for most authentic place to learn finance and accounting. Without wasting much of your time, let's get started. What is current ratio? Current ratio is actually a part of the ratio analysis framework and it comes under this solvency ratio. Though the solvency ratio is divided into three parts, we'll be limiting our discussion right now to the current ratio part. So what is current ratio? Again, the current ratio is basically company's capacity to repay its short-term loans or liabilities over the next 1 year period. So what does that means basically that whether the company has enough short-term assets to cover for its current liabilities. Actually, explain this with the help of a formula. Current ratio's formula is nothing but current assets divided by current liabilities. What are current assets? Current assets is nothing but those assets which can be liquidated, which can be sold, which can be liquidated within a year's time into cash. Likewise, what are current liabilities? These are those liabilities which have to be repaid within a year. So that 1 year period is the most important thing to note. So current assets examples could be something like marketable securities. Current assets are like cash, marketable securities, accounts receivables, and then we have inventory. These are the common examples of current assets. Prepaid expenses could be another one. So these are the 4 or 5 examples of current assets. Examples of current liabilities could be something like accounts payable, accrued expenses, accrued taxes, and similarly, there could be some other short-term liabilities like short-term loan that needs to be paid within a year. And you can also consider current portion of long-term debt also as a part of the current liability because that also needs to be paid within a year's time frame. Okay, so these are the examples of current assets and current liabilities. Now let's go back to our discussion of current ratio. So as you can see, the current ratio can be calculated as current assets divided by current liabilities. Let's take an example. Current assets, let's say for a company, current assets was 100 and current liabilities was 80. Okay, so how much will be the current ratio? Current ratio, as we can see in the formula, would be current assets divided by current liabilities, and it comes out to be 1.25. So whether this is a good position or not, actually if you consider only this ratio, it seems like yes, current assets are enough to pay for its current liabilities, and hence this is a good position to be in, right? Likewise, let's say if current ratio was less than 1, then what would you have done? If current ratio is greater than 1, obviously we are saying that it's a good position to be in. When current ratio is less than 1, we note that current assets won't be enough to pay for current liabilities. So it's not a good position, right? You have to find out other liquidity measures, liquidity measures means, you have to find out other types of ways via loan from bank, etc., to pay off your current liabilities, right? To be sought out. So this is not a good position to be in. If current ratio is equal to 1, obviously it's just enough to ensure that your liabilities are met. So current assets, current liabilities, and its ratio is called as current ratio, and it's a very simple ratio to actually look at. So having understood what current ratio is and how do we interpret current ratios, let's now look at how we calculate this for Colgate. Now that we have understood how current ratio is calculated, let's understand its interpretation. So there could be three scenarios, right? Current ratio greater than 1, current ratio equal to 1, and current ratio as less than 1. So which one do you think is the most desirable? Obviously, current ratio, if it is greater than 1, that means you have sufficient current assets to cover for its current liability. So this would be a good position. How about current ratio equal to 1? Current ratio equal to 1 would mean sufficient, just enough. So that would be okay. But current ratio which is less than 1 would be a tricky situation. So I would call this as a bad position to be in, because you don't have sufficient current assets to cover for its current liabilities. And you might have to find out some other ways to or additional liquidity measures you might have to take to pay for your current liabilities. All right, so this is how you can interpret current ratios. Now, having understood the current ratio in detail, let us look at how this applies to our case study, that is Colgate. The last thing I want to discuss about the current ratio is its limitations. Okay, so it comes with lots of limitations. I will highlight, primarily 2 or 3 of them. The first one is that it doesn't consider the quality of assets. So what do I mean by this is that, you remember current assets are divided into various types, as I said: cash and cash equivalent, marketable securities, account receivables, prepaid expenses, etc., right? So let's imagine a situation where we have, let's say, company A, and company A has all of its current assets. Let's say it's 100, okay? And all of its current assets as cash, okay? And let's say there is another company that's called as company B, and for company B, all of its current assets is in let's say inventory, okay? So both the companies, company A and company B, both of them have 100 as its current assets. Let's imagine that current liabilities is 80, right? And I will assume that company B also has 80 as its current liability. So what will be its current ratio? As we calculated earlier as well for these numbers, this is 100 divided by 80, that is 1.25, and 100 divided by 80 as 1.25 for both the companies. Which company is better off when we talk about current ratios? Now, the question is, which company is better off in terms of paying capability when we consider the paying capability with respect to current liabilities, right? You have to pay off your current liabilities within a year, right? So when company A has all of its in cash, so this has a right quality of asset when it comes to repaying capabilities. On the other hand, when we consider company B, this inventory will take a longer time to convert into, let's say, goods which can be sold, and then finally when it is sold, then that's when you will get cash, right? So this has a longer cash cycle associated with it. So this might not be the right quality of good quality to pay off your current liabilities. So it doesn't consider the quality of assets, is what I was trying to tell you, okay, when we talk about current ratios. So to address this, we actually look at other ratios. These are like a quick ratios and cash ratios. We will discuss this in our subsequent videos. But for the time being, you understand this as the limitation of current ratios. Second limitation is that, it doesn't give us anything about the profitability of the company. Cannot be measured using this. Okay, obviously it's not income statement ratio, so it's just a balance sheet ratio, so it doesn't measure The profitability doesn't give us any indication of how the profitability of the company is or how this ratio affects the profitability. There's no relationship as such. Now, another limitation with respect to this is that it can be manipulated as well at times. Manipulation would mean, obviously, when we talk about the balance sheet and income statement and cash flows, all of these can be subject to accounting gimmicks as well from the management side. So let's say if there is a scenario where current assets and current liabilities increase by the same amount. Okay, what happens if the current assets and current liabilities increase by the same amount? Your current ratio will decline. You can try that. Let me do that, right? I'll do that. 120. So I've increased this by 20, and let me increase current liabilities also by 20. So how much is the ratio now? It was 1.25 earlier. Now it is 1.2. I'll just revert it. Earlier it was 180, right? So current assets was 100 and 80 was the liability, right? Current liabilities. So the ratio was 100 divided by 80. Now I've increased this to 120 and 100, right? Both of them increased by the same amount. The ratio will become 1.2. So obviously it can be subject to manipulation like this. If you want to put a rosy picture about your company, you can decrease your current assets and current liabilities, or you can increase or decrease, you can do it accordingly. Another limitation is that this ratio can also be manipulated. Manipulated means that this can be changed by doing some accounting gimmicks. What do I mean by this is, let's say if you increase current assets and current liabilities by the same amount, what is the impact on current ratio? And let's say I'll just put some numbers and you will appreciate after that. Current assets, current liabilities, right? So in our earlier example, it was 100 and 80. Let's say if you increase it by the same amount, let's say now it becomes 120 and 100. So what happens to the current ratio? Current ratio earlier was 100 divided by 80, that was 1.25. And now in another case, how much is this? 1.2. So increase in current asset, and the same amount, if you increase the current liabilities, the ratio actually decreases, right? So may not be the good way to look at it. But let's say if you decrease it in the same amount, let's say now it becomes from 100 it becomes 80, and from 80 it becomes 60 as current liabilities. What will be the ratio? As you can see, the ratio increases here. So if management has to manipulate means that if they want to manipulate so that they provide a rosy picture to the analysts, they they can possibly do this. So as an analyst, you need to be mindful that these things can happen, and therefore you need to analyze the balance sheets very carefully. So as I said, this is a manipulation and it's a limitation of current ratio. It can be manipulated easily. Okay, so I hope it's clear as far as the current ratio is concerned. What is a quick ratio? Quick ratio is actually a part of the ratio analysis framework, and it comes under the solvency ratio. Solvency ratio is again divided into three parts: current ratio, quick ratio, and cash ratio. In our last video, we did discuss about the current ratio in much more detail. What exactly is the formula, and what are the certain limitations? Quick ratio actually addresses the limitations of current ratio, and we'll discuss all of that in more detail. But just to give you a definition of what quick ratio is, quick ratio actually checks for the short-term liquidity of the company and whether the company will be in a position to pay off its short-term liabilities. That is the current liabilities. I'll come to the formula and then we will discuss what are the limitations of current ratio and how quick ratio actually addresses that. So let's look at the formula first and then we will get into the detail. Here is the formula of quick ratio. Look at the formula of quick ratio. Cash plus marketable securities plus account receivables divided by your current liabilities. What was current ratio? Current ratio was basically current assets divided by current liabilities, right? This was the formula for current ratio, but the formula for quick ratio is cash plus marketable securities plus account receivable divided by current liabilities, right? How is this formula different from quick ratio? The primary difference, if you look closely, is that in the numerator, inventory is missing. Cash, marketable securities, account receivables divided by current liabilities. There's no inventory on the top. The formula for quick ratio can also be written like this. Quick ratio equal to current assets minus inventory. Okay, minus inventory. So we are saying that we should not include inventory and divide it by current liabilities. Why is the reason, what is the reason why we are not including inventory in the numerator? The answer lies in the way, we define this ratio. It's called as quick, right? So what we are assuming is that how quickly we can convert the current assets into cash. That is a parameter. Inventory, if you look at, inventory takes a bit longer as compared to these, right? Inventory, how will the process of inventory will happen if it has to convert into cash? First, it will be a raw material inventory, then it will become work in progress inventory, then it will be finished goods, then finally the sales process will happen. Once the sales process happens, if it is in cash, you get cash, right? But if it isn't, you convert that into account receivable. So if you look at, inventory has a long process of converting that current asset into cash. So that's why you kind of reduce the quick ratio. Reduce the inventory from the numerator. I'll come to the limitations and why quick ratio is super useful if you are looking at analyzing a specific company. And all financial analysts, believe me, use this as one of the most important ratios to look at. Let's look at an example. Let's say there's a company whose current assets is 1200. Okay, and I would also give you the bifurcation of the current assets: cash, marketable securities, right? We just discussed marketable securities. Marketable securities are those securities which you tradable. You can easily sell that and convert into cash. Accounts receivables, and then let's say inventory. So let's assume we have these 4 types of current assets. And I'll also give you the bifurcation: 100, 100, let's say this is 200, and inventory, let's say it is, for argument's sake, it is 800. Okay, so this is sum total is 1200. Let's take the current liabilities. Though the bifurcation won't be important, I'll just give you some random number. This, let's say it's 1000. Okay, if you calculate the current ratio will be how much? Current ratio will be current assets 1200 divided by current liabilities, right? We get this as 1.2. How do we interpret? If you remember from our last video, we did say that if current ratio is greater than 1, it's a good situation to be in. It seems like it's a good position, right, for a company. Current ratio greater than 1 is a good position. But what about quick ratio? If you look at the quick ratio, how did we define the formula? It was like cash plus marketable securities plus account receivables divided by your current liabilities, or you can divide it by current liabilities. So I'll use the second formula. It's one and the same. So this is current assets minus inventory divided by your current liabilities. So what do we get here? We get 0.4. Now imagine a scenario where you are running a company and all of your inventory, like in this case, majority of your current assets is actually stuck here in the form of inventory, and you're unable to sell the inventory. So what's happening? Quick ratio will immediately detect that situation, that your company is not having the right kind of liquidity position because most of your current asset is stuck in the form of inventory. However, when you look at current ratio will not be able to detect that, right? That's the limitation of current ratio. It doesn't account for the quality of current assets. How soon can it be converted into cash? But quick ratio addresses that limitation by removing the inventory from the formula itself. An excellent one to actually look at. Okay, so I assume that you now understand the difference between the two and what is quick ratio and how it is interpreted. Interpretation would be similar actually, just like the current ratio. If it is greater than 1, it's a good position, of course. If it is equal to 1, then obviously it's a reasonable, I would say it's okay. And if it is less than 1, then it's a worrying position, bad situation to be in. So you might want to investigate further and see what's happening within the company in this case. So that's how quick ratio is interpreted. What is cash ratio? Cash ratio is a part of the ratio analysis framework and it comes under the solvency ratio. In our previous videos, we discussed about current ratio and quick ratio, and each of these ratios have certain limitations associated with it and measures the liquidity of the company. Cash ratio also measures the liquidity of the company, but it's a bit more aggressive if you look at. What's the formula for current ratio? Current ratio is like current assets divided by current liabilities. However, when we talk about quick ratio, we say that since inventory is difficult to convert into cash pretty quickly, we should deduct inventory from the formula. So quick ratio is current assets minus inventory divided by your current liabilities. However, when we look at the cash ratio, the formula is defined in a way that you need to take only the cash related components within the balance sheet, and of course you can include marketable securities which can be readily converted into cash. So cash equivalents, marketable securities, these are the things which go in the numerator, and cash ratio basically tries to measure the liquidity position by seeing that whether a combination of these two items are enough to pay off its current liabilities. That's how cash ratio is all about. And let's look at the formula. Cash ratio formula: cash plus cash equivalents. You can also make this as marketable securities. It's one and the same, divided by your total current liabilities. It's a bit more aggressive in terms of looking at the liquidity of the company, but some analysts do use it. Many don't. And I'll come to the reason as to why it is not used by many analysts too. I'll use the same example as we did in the previous video of quick ratio, where we had current assets as 1200, cash as 100, marketable securities 100, account receivables 200, and inventory is 800. So here we calculated the current ratio, which was current assets divided by current liabilities, and the quick ratio was current assets minus inventory divided by current liabilities. So let's now calculate the cash ratio. Cash ratio will be equal to cash plus marketable securities or cash equivalents divided by your current liabilities. So what do we get? We get this as 0.2. So how do we interpret the cash ratio of 0.2? Is it good? Is it bad? Or we have to look at something else as well? Now, when we were discussing about current ratio and quick ratio in our previous videos, we understood that greater than 1 was a good position to be in and less than 1 was kind of a slightly concerning situation. But cash ratio of 0.2, should we say that it's a bad situation to be in? I think there is something more to be looked at. Here, what happens is when you have a cash ratio which is, let's say, greater than 1 for a company which you are analyzing. Now, what does that mean? From liquidity point of view, yes, liquidity point of view, the company is doing great, okay, because you will be able to use your cash which is there in a bank, and you'll be able to pay off your current liabilities. But from the growth point of view, what does it mean? From growth point of view, if you look at, it essentially means that you probably don't have sufficient growth opportunities, right? Because had you had more growth opportunities, you would have rather used this cash in investing in growth projects, which you're not doing it right now. You're just sitting on cash. it does mean that you are not having the right kind of projects to invest, and that's why you have cash at your hand. There could be other reasons as well. The other reasons could be that you are piling up cash for a potential acquisition or something. That's a separate story altogether. But in general, let's say if cash ratio is greater than 1, liquidity is, yes, it's great, but from growth point of view, it is not good at all. But if it is less than 1, like in this case it was 0.2, it's fair. This is what a healthy cash ratio should actually look like. Usually, the more acceptable one is in the range of 0.2 to 0.3 times is what the cash ratio should be for a healthy company. However, again, as I said, greater than 1, liquidity point of view, it's good, but from growth point of view, it is not good at all. Or you need to again go through the reasons why a company is piling up cash. Is it for a potential acquisition or for some kind of other investments which the balance sheet is not showing? So more investigation will be required from that. So not many analysts are kind of fan of this ratio, but these two ratios, yes, definitely, they definitely look at these to interpret the overall liquidity position of the company. I hope you found this video to be useful. Please do like and share. And if you have any feedback or want to suggest a topic for any future videos, then you may do so by writing about it in the comments section. Also, we come up with interesting videos on finance and accounting topics regularly. So if you haven't subscribed to our channel yet, then please do so by clicking on the subscribe button below so that you can get the notification about our latest videos as soon as we release one. Thank you for watching. Have a nice day.